This is the Griffin Realty Group Ask a Griffin podcast, episode number 36, Financing. What's the difference between pre-qualification and a loan commitment? Are you a home seller or buyer who has questions about selling or buying residential property, but you can't find an easy way to get the answers? Well, then, hey, you're definitely in the right place. I'm Danny Griffin, the founder of the Griffin Realty Group and the host of the Ask a Griffin podcast. Now, to help you take immediate action to get started in the right direction, if you need to sell or buy property right now or in the very near future, you can take advantage of our free step-by-step guides that are waiting for you at griffincourses.com. That's Griffin courses.com. All right, let's get started. Again, we're in our series on financing, and the question on the table is, what's the difference between pre-qualification and a loan commitment? So the first point in the podcast here is that you are not really truly in a pre-qualification process in a proper way without a lender explaining all the steps. See, when you go to griffincourses.com and you get our free buyer course, the very first thing that we talk about is representation, that the buyer agent, has a responsibility to represent you and the interest of you, the buyer, not the seller. The listing agent is obvious, but not always still, even in this day and age, is it obvious to people that the buyer agent fully represents them in the whole process. It's not just find me the house. It's actually slow down. The first step here is to get pre-qualified with a lender. And pre-qualification is a terminology that we get stuck on and we think, oh, what do? I just pick up the phone, they pull my credit report, and maybe they ask me for tax returns or state my income, and I'm good to go, right? Wrong. You really want to, when you sit with that lender, it's best to just take a beat. And I get that sometimes you might be out there looking and all of a sudden you get a good buyer agent and they're trying to slow you down to get this organized, but you have to have that house. I get that this could be a very accelerated process that needs to happen quickly. But for those of you that are properly prepared in thinking about this with me in this podcast, or you've gotten one of our courses, working with one of our agents, good. But we want you to really be with our lender, understanding everything that is going to be required of you in the entirety of the process. What does that look like? Because as we help you as the agents, we want you to understand that pre-qualification gets you started and we talked about this in the last episode, it gets you started for a lot of reasons, not the least of which is, number one, when you're pre-qualified, you know what you're ready, willing, and able and can spend or will be lent to you. So that limits it. And then we can match you up as an agent to what that money is actually buying. But secondly, down the line in the process, there will be a negotiation. And if it's a hot market, we need to prove to the seller and the listing agent that you are truly and deeply pre-qualified, to the point where we're crossing over to almost an approval process. And I'll get into that in a second. But I really want to hit this first point hard here, that you really need to slow down, meet with a lender, and talk through with a buyer agent representative who's explaining to you that this is a very difficult process to go through. Look at post-recession, when we had a banking crisis, it was because all of the lending laws and rules were loosened. I mean, after being a very controlled industry by the Glass-Steagall Act, the banking industry was very highly regulated since the Depression. When the financial markets collapsed, you had rules and laws in place that governed banking all the way up into the late 90s, where things started to get loosened up again. And the next thing you know, we had a free-for-all. We had things like stated income. You could just tell the lender what you made. Well, guess what happens when you do that? You start fudging it to get what you want. There's no proof. The underwriting process was almost thrown out the door to a large extent with vetting. Well, post the last recession, where we really hurt ourselves financially as a country in the United States, we went back to some very stringent laws and rules. And really, it's more rules of underwriting. The banking industry became regulated again. And all of that regulation was a good thing because it forced the underwriting process, meaning you're not just going to state this. You're going to give us tax returns. If we ask for other tax returns, if we ask for qualification in the underwriting process, you're either going to give it to us or be rejected. So you have to understand that that's a very serious process. The second point here is a pre-qualification or a pre-approval letter does not indicate that a full mortgage commitment has occurred. Let's just get this straight. That again, the reason for understanding the process is you understand that the pre-approval letter or the pre-qualification process that goes along with it is simply the early on parts of it so that you can present an offer and say, look, we're not starting from zero when we present our offer to you, the seller and the seller's agent. We actually have gone through the process. We're ready to go to a large extent. Now, the smart listing agent is going to ask, what does that mean? I want to speak directly to your lender. I want to know how far along you really are. So oftentimes as a listing agent, I will ask for the lender's name before we accept the offer, and I will pick up the phone and say, tell me how far along you really are. So they're going to tell me from a banking standpoint how much work they have or have not done to really underwrite you, the buyer. Meaning, have they really vetted you? Underwriting is a fancy term for vetting you. Have they really vetted you? Have they really gotten the tax returns they need? Have they looked at those tax returns and asked you for explanation of any confusing items? Are you really, truly have the ability to be underwritten? I was going to say underwritable. I don't think that's really a term, but can you be underwritten as a human being financially? And with all your past financial history. So there's a real deep vetting process there. But then the second part of this, you must understand, and I'm going to talk about real estate in the context of Massachusetts, because each state might be a little bit different. But in our case, our tradition is that we would go to an offer to purchase first that delineates all the critical dates and deadlines and the several deposits that occur. Meaning, traditionally, you'll see $500 to $1,000 down to bind an offer to purchase, right? And what will be delineated in there is a second contract signing called the purchase and sales agreement. Now, why would we do that? Well, I think it's probably a decent tradition to the extent that we know in the first 10 days, 2 weeks, something like that type of period, there will be a home inspection. And in this home inspection world that we live in, home inspectors are more worried about being sued for missing something. So their laundry list of items they're going to check is long. And they are always going to default to saying, well, this isn't up to today's standards. This needs to be upgraded. And that can downright scare anybody out of a deal. So nobody really makes a commitment to the deal until after the home inspection. Then a purchase and sales agreement is signed, and then a much bigger deposit is put down. And there may be other contingencies, but the big one is the mortgage commitment contingency. That's the one that's out from the home inspection, because the bank and the buyer really don't want to get into that process until there's certainty that that's the next big issue to deal with. So what happens is the appraisal is then ordered. Why? Because in the pre-approval process, we started to look at the financial viability of the human. Now we're going to look at the financial viability of the product that's being purchased. We have to vet that next. Well, we, being the bank, has to vet that next on behalf of the buyer, because a mortgage loan is going to be secured by that physical asset, that property. So when the appraiser goes out, they're going to look at, does this reach a value that matches what the buyer would put down and the loan that's being requested. So let's just presume, for sake of round numbers, we have $1 million property. And let's say that the buyer is putting 20% down. If the mortgage, the appraisal doesn't come in at $1 million, we have an issue, because that will screw up the loan to value. So let's say it comes in at only 900 and we're still looking for that 20% down. So at the 900, let's say the bank is only looking to offer 80% of that value. Well, the buyer has an opportunity to either walk away because they weren't able to get a commitment. Property didn't appraise. You'll hear that, right? And so that's an issue. Or they could put more money down to make up the $100,000 difference. So a lot of people don't want to do that. So the deal might end on a bad appraisal because the mortgage commitment doesn't work for the deal that was assumed. In the great case, sometimes the property is appraised over value. But for the most part, I would tell you, you're going to see appraisals come in around the purchase price, because what the bank is simply trying to do is justify the value. See, the market really truly sets the value. What a buyer and a seller are willing to pay each other, that sets the marketplace. And the bank is just trying to have the appraisal or the appraiser vet the property, say, is this reasonable? Is this reasonable? right? So just understand that's the reality of the situation. People want to explain it 100 different ways. I've been doing this for a long time. That's the reality of the moment. You'll see plenty of appraisals come right in at the purchase price that's stated in the purchase and sales agreement, which the appraiser typically asks for. Okay. So it's really a vetting of the property and the people. And so that's what would lead to the situation having a full-blown loan commitment when both of those are done. So you see the difference between pre-approval and pre-qualification? We're not pre-approving the property or pre-qualifying the property. That's about the person. And we can't even deal with the property until there's a property under agreement and appraisal has taken place. Now, the last point here is even a final commitment letter may come with a list of final conditions. So this is a little bit of a tricky spot here where depending on what those conditions are, can they be satisfied before the loan commitment date expires? Now, if you're a buyer agent, you want to pay close attention to this. If there's not a full and true commitment from the bank and there are conditions that need to be met, you must secure an extension of time whereby your buyer can fully finish those conditions. Because otherwise, you are putting the deposit at risk. Let's assume the mortgage commitment date expires and there are conditions like you must provide X and they can't provide it, or they can't provide it in the time frame prior to closing. Well, the buyer's deposit is now at risk. So it's very important to understand that even at a final loan commitment, there better be no conditions, otherwise an extension is required. So let me go back over this, okay? The question on the table about financing when it comes to the buy side of a residential real estate transaction begs the question, what's the difference between pre-qualification and a loan commitment? So you're not truly, first point, in a pre-qualification process without the lender explaining all this. If you listen to this podcast, okay, I've explained it, but you really want to sit with a lender and have them explain their process, which might have some twists and turns because it's their bank, or they're putting if they're a loan mortgage company, they're putting it out to a bank who has conditions that they have to fulfill, right? Next, a pre-qualification or pre-approval letter does not indicate that a full mortgage commitment has occurred. That's only when we have a property that we can vet, the appraisal's been done. And lastly, even with a final commitment letter, you want to make sure it's condition-free, otherwise secure an extension. So let me summarize it this way. A buyer should never assume that they are in the process of fully securing a mortgage commitment until a lender explains the steps in their entirety. A pre-approval letter simply means that the buyer's personal financial capabilities are being vetted and seem to be in order at a certain purchase price level, seem. However, a full mortgage loan commitment is not secure until all bank conditions have been met. This is through their underwriting process. And that the viability of the property as a bankable asset has been confirmed. Okay, so remember now, you can take immediate action to get started in the right direction if you need to buy or sell property right now or in the very near future by getting our full step-by-step guides, not just one portion of it like this, but the full step-by-step guides that are waiting for you at griffincourses.com. That's GRIFFIN courses.com. Also, don't forget you can subscribe to this podcast on iTunes, Spotify, or wherever you listen so that you don't miss out on any of the insights each time we upload an episode. We also post all of the episodes on our social media channels so you can go back and listen to them. So just remember, if you'd like to see them live, turn on your notifications for Griffin Realty Group, and you won't miss the reminders. We'd also appreciate if you would share our content with other people just like you who are thinking about buying or selling in the near future so they get the help they need, the proper help they need. They need a plan. Everybody needs a plan when you're dealing in these major financial transactions. Hey, thanks for listening, but remember, nobody's coming for you, so take action and go get to work on your own plan for buying or selling property, and we'll see you in the next episode.